This video will discuss repayment of federal student loans. There are several rights and responsibilities that you have as a borrower. You will learn all of them when you complete exit counseling, which will be required when you graduate or if you drop below half-time enrollment. Two important responsibilities is that you must keep your contact information updated with your loan servicer, and you are required to pay back your loans. Each loan has one 6-month grace period. The grace period starts when you drop below half-time enrollment, and all loan grace periods run concurrently. If you re-enter school, you will not get another grace period on existing loans, but will have new grace on your new loans. Payments are made directly to the loan servicer, and your loan can be paid off at any time. You will learn about the different repayment plan options that you can choose from on the following slides. This chart gives an example of what monthly payment amounts would look like for an average ESU student. ESU students who completed a bachelor degree in May 2018 borrowed, on average, $20,382. Based upon that amount and using a household size of 1 with $25,000 annual income for a Kansas resident, these are the income-driven payment amounts. All students are automatically placed in the standard plan when their loans enter repayment. The monthly payment amount will not change over time unless additional debt is incurred. In comparison to the other available repayment plans, this one will cost the least amount in interest. The graduated repayment plan allows you to make smaller monthly payments to start out, then increases your payment every 2 years. This plan works under the assumption that you'll be earning more money over time. It will cost you more interest, and your final monthly payments will be significantly higher than on the standard plan. Under this plan, the payments are stretched out over a longer time. However, the maximum time frame is dependent upon whether you qualify for income-based repayment or income-based repayment for new borrowers. You will often hear income-based repayment referred to as IBR. To stay on this plan, you must submit documentation each year to recertify, which means your payment can go up or down each year. Upon a set number of years in one of these plans, your remaining loan balance could be forgiven. However, the amount that is forgiven becomes taxable income the following year when your taxes are filed. The Income Contingent Plan, or ICR, works like the IBR plan, with some difference in the information used for recertification and initial application. Any amount forgiven under this plan is also considered taxable income. The difference between pay-as-you-earn and the previous plans we've looked at is that it also takes the poverty guideline into account when determining the payment amount. Additionally, there are very specific requirements as to who is eligible. Once again, any amount forgiven is considered taxable income. Revised Pay-as-you-earn is based on the Pay-as-you-earn plan. However, it was created to open up access to more borrowers. Again, any forgiven loan amount is considered taxable income. As mentioned on all income-driven plans, the amount forgiven is considered taxable income. This could create a burden for the borrower the next year when they file taxes. For example, if $20,000 is forgiven, the next year when taxes are filed, approximately $6,000 in income tax could be charged to that borrower. Another thing to note, any plan that lowers your payment or extends the length of time to pay will cost you more in interest than the standard repayment plan. Any changes to your repayment plan will go through your loan servicer. However, the application or recertification is completed on studentloans.gov. Income and tax information can be provided with the IRS data retrieval tool and the application submitted electronically. However, if your income has changed since your last taxes were filed, the application will need printed and submitted with additional documentation. If you file joint taxes, your spouse has to co-sign the application. With the many options for lower monthly payments or postponing payments, there is little reason for a borrower to be late on their student loan payments. However, once a borrower is 31 days past due, their loan is considered delinquent, and this delinquency will be reported on your credit report. At 270 days past due, a borrower is considered defaulted, and the loans will be sent to collections. The default is reported on the credit report, and the borrower will not be eligible for federal financial aid. Additionally, wages can be garnished or income tax returns withheld to pay off the defaulted balance.